Awesome. Well, thanks, Jonathan. Appreciate it, and nice to meet you all. Um, Quick intro on me. Yeah, Jonathan mentioned a little bit there, but I'll tell you more about me and more about our firm and strategy, and a bit about industrial real estate and what strategy we're using within that asset class. But yeah, I've always been an entrepreneur. Going back to when I was 20, I bought a business. Kind of uncommon now that I look back on it a little bit, but and so really had that bug from an early age, and was a finance major, and started to invest in real estate in the Bay Area in California back in the early 2010s, and made some money, but a lot of luck. Certainly captured as much as I could with a lot of hard work, but I was essentially flipping some houses there, and found myself starting to invest passively in commercial real estate because I didn't frankly want to manage tenants and hold these assets long term. I wanted to get in and out and find something that wouldn't require me to be on the phone managing a property or managing a manager. Live over here in Fort Worth in DFW. I don't know if everyone's from the area here, but right here in DFW. And in 2019, I joined Mad Capital Partners, who I had a relationship with for a while before that, and had been partnering with them in a couple different capacities. But we are Mad Capital Partners is a private investment firm that's focused on industrial real estate and industrial operating companies. And as of now, we own and manage a little over $1 billion in assets. Here's a good map. The circles are assets that we own today, and some of the larger circles, there's multiple assets in a market like that. But the stars are assets that we've gone full cycle, have owned and sold in the past. So quite the footprint across the U.S. and it's primarily industrials. You can see on this chart on the bottom here. We manage several industrial real estate funds. We participate in some joint ventures, namely with the related companies out of New York. I have a very large joint venture with them. They're a big institutional group out of New York with like 60 something billion in assets under management. And we also have a private equity wing where we buy and operate industrial businesses. And we've syndicated those opportunities to investors as well. But yeah, as of today, we've been very fortunate to have a great track record, and we have a fantastic team. There's 24 of us here, and I head up the capital raising on the equity side, but also on the debt side. So full capital markets, really pulling together all aspects of capital before we make any acquisition. And what we're doing here is buying single tenant, triple net lease industrial real estate. So I put some images here just to kind of give an example of what that looks like, right? It's those buildings that you oftentimes don't look twice at. Oftentimes they're kind of ugly, right? It's four walls and a roof and dock doors, exactly what you see here. These are properties that we've owned and managed. At one on the top right there is actually kind of a nicer looking aspect. We did a build to suit development there. And so we've had quite a few of those development projects where we've expanded the footprint of a property for our tenant that's in place. And most of these tenants are manufacturing companies and food production companies. So these are not typically your third party logistics companies, right? That are just large warehouses that sort of receive and ship out product for a number of different customers, or even a single company like Amazon would do. We like this manufacturing side. We feel like it's the backbone of the American economy. And most of these companies are making widgets and parts, and it's typically B2B sales. But that picture on the bottom left, you see the guy grinding on a tank. Just kind of an illustration of one of our operating companies we own and operate here in DFW. If you know where Venus is, just south of Dallas and Fort Worth by about 30, 40 minutes. One company there we own called Hughes Tank Company. They manufacture steel tanks for a lot of petroleum and chemical applications. So a little demonstration there, but most of what we do is in real estate. A little kind of intro to the team here. There's me at the bottom, but the three folks above me are the three partners here. Combined have 50 plus years now of commercial real estate experience. And And really, what I wanted to start, sharing with you guys is a little background on industrial real estate, some historical data, and then kind of show where we're going, what's driving changes in the market, and then again focus in on what our specific strategy is within industrial real estate. Right? It's a big segment. It's a big asset class. It's just like any, whether it's multifamily or office. There's lots of sub asset classes, right? But this is a great chart going back to 2006. And it shows, what I would point to is the red line. That is the vacancy rate for industrial real estate since 2006 to now. So you see that it goes up at the Great Financial Crisis, and it peaks out about late 2009 or so, a little over 10%, right? And no shocker there, right? The economy was in shambles and businesses were struggling and consumers were struggling. And so you see the slow recovery where vacancy is coming down, and more product is being leased up, over a good, 10-year period or plus, right? Even more than that. And so you see vacancy come way down. And a lot of that's, well, we'll talk about drivers here, but it's coming way down to 2020. Obviously, you have a little tick up from COVID there, and then you see this massive push down into very low vacancy rates in industrial real estate because obviously we saw a lot of disruptions. Again, we'll talk about that in a second. But and then from 22 on up, we've seen it come back up as a lot of product has come online, meaning a lot of construction has finished, entered the market for lease. And so we also ran into a increase in interest rates, as we all know, for the last 2 years. So that really slowed down leasing activity while a lot of the product that had already started years before had started to come online. And so you'll see that forecast going forward of kind of peaking out and leveling out there. And so, as rates, we're going to see them hopefully come down over the next year or two. But there's also a lot of, so hopefully some more economic activity and more confidence in leasing of industrial real estate. Um, but excuse me, a lot of product, a lot of construction has not begun over the last couple of years because of the cost of financing and the cost of borrowing there. So that's been prohibitive for a lot of spec developers who would just start building 500,000 square feet. And in the good times, 3, 4 years ago, these guys were getting leasing offers while they were still pouring foundation. Right? I mean, they had a huge amount of demand and couldn't keep up with it. So people started to pump the brakes there because they didn't know if they'd see that activity, that demand, and the cost of financing was so high. But a little data here just on specifically manufacturing construction spending tells a little different story, right? Industrial as a whole. I mean, I would break it into a few segments, one being third-party logistics, right? The warehouses. Then you have manufacturing, food production, which is where we are heavily. And then you have special use, which is more like, think grain silos and things along that line that are specifically built for one application. And then you have flex industrial, right? And that's the kind of stuff you see small businesses operating out of, right? It looks like a very long row of roll-up doors where they're typically smaller suites for, Joe the plumber or, Sarah the electrician, right? Whoever is in these bays needing 3 to 5 thousand square feet. But again, zeroing in on manufacturing, just because we have a lot of experience there, we want to show, how much spending has been going into it, and a couple of these significant government acts and incentives that have driven a lot of that. But again, we'll talk about some other tailwinds there too. So you see a huge spike here going into 2022 of spending on manufacturing going way up there. But some other tailwinds here, some other drivers have been e-commerce, right? And so I think this is a really nice chart to show because we've seen a huge amount of fluctuation in the last 4 or 5 years, all due to COVID. But really, if you go back, this chart goes back to 2014 and it shows e-commerce as a percentage of total retail sales, right? And so you see from 2014 going on, it's flat. It's a steady increase over year after year. And in fact, this graph I shortened. It originally I had it going back to 2006. It was just too long. It's hard to see the data clearly. And to be honest, it just was a extremely steady flat line going up. And then obviously COVID happens, huge spike. Everyone's buying everything online. so they don't have to go into brick and mortar stores and risk getting COVID-19. And then you see kind of a pullback there. It levels out, and look where we are, right? You look at about tw mid 22, and you see that percentage of e-commerce or e-commerce as a percentage of total sales kind of following exactly on. I don't know if you could see my cursor, but it's almost like if you remove the last 2020 through 2022, it's like it would have kept going that exact trajectory. So it's pretty cool to see that we're kind of right back in line with that trend in which the direction in which our society is moving, which is, hey, there's more products and services available on your phone, on your computer, that can be purchased then and delivered to your home. Some other kind of interesting facts that you might be, I found this fascinating about e-commerce sales, but Prologis, there's a quote here from Prologis, and they are the largest global operator of industrial real estate, right? So what they say is has a lot of data, a lot of experience behind it. And they say for every billion dollars of online sales, there's another 1.2 million square feet of industrial real estate that's needed to support that, right? So, and the graph beneath that shows, hey, what does worldwide e-commerce sales look like today? What do we project them going forward? So obviously a kind of an upward trend there. And if you do the math here, right, $6.3 trillion in 2024 to a projected 7.9 in 27, you do that math there, you can actually extrapolate how many square feet, right? Because they're saying, well, every billion dollars. And what it comes out to is it's about 1.9 and change, almost 2 billion square feet of additional industrial real estate will be needed to support that growth just over the next 3 years, right? And that's global, of course, but the U.S. is a huge portion of global commerce. Obviously, we're the world's powerhouse there, so it's pretty fascinating to see that. And even though that's not e-commerce, distribution centers are not our focus. It's a really nice tailwind that we see just in industrial real estate in general, right? The demand for industrial real estate, and many of these properties can be have multi-purposes, right? And we've seen some of these properties, hey, someone's assembling products in here and then they move or whatever happens, and then it might get used for warehousing and distribution as well. So always a nice thing to see increasing demand over time and looking forward as well. But going back to manufacturing, another driver here of this increase in demand for industrial real estate, of course, is that manufacturing. And so you see a lot of onshoring of operations from overseas. So this graph really shows, kind of like the previous one, U.S. manufacturing construction. So you see a huge uptick. And again, we're going to talk about that. So, why is that, right? And one reason is there's a lot of government incentives. Um, you know,
Okay. Yeah, I'm on a video.
Okay, go ahead. Sorry. Go ahead. No worries. On the bottom right, you see just a clip from an article about the CHIPS grant. You guys might have heard about this, but the Biden administration basically awards grants to semiconductor chip manufacturers who have qualifying manufacturing plants. So, Taiwan Semiconductor Company, Samsung, Micron, Taiwan Semiconductor, they have a massive plant that's underway in North Phoenix. I think it's Micron that has one going on in Ohio, but these are multi-billion dollar manufacturing plants. But what you're seeing here on the and to the left of that, and don't worry about reading it all, but essentially it's a kind of a graph that's showing all of the tax incentives all the way from the beginning of the process of manufacturing electric vehicles all the way to delivery. And it starts at investing in a qualified manufacturing plant. It also you also participate in that in critical mineral production, battery cell manufacturing, even the consumer, when they actually buy the car, they get a tax credit, right? So there's a huge amount of tax credits there that are promoting the manufacturing of these electric vehicles, right? So that's just a couple examples, but that's been a driver there. But also there's a lot of political tensions, right? And obviously we have a change in administration coming in January. And there's been, obviously an adversarial relationship with the US and China and trade. And yeah, there's been some tariffs and talks of more tariffs, of course. And all of that is risk that U.S. corporations are looking at and going, look, I don't know what the future holds, and so I would like to skirt that risk and move my manufacturing or my supply chains to U.S. based sources. So we've seen that driving that as well. But my favorite really is how U.S. companies are basically just looking at supply chain risk, right? And these are just, very quickly grabbed. I mean, it's not hard to find all the supply chain disruptions out there, right? I mean, you have a few different conflicts going on worldwide, a few threatening conflicts. That one in the bottom left, if you remember the Ever Given container ship that got lodged in the Suez Canal, that was lodged for it was about 10 days, right? So it doesn't seem like a long time. But sorry, I think it was 8 days, but they said it costs the global economy about $10 billion per day that was lodged there. So huge disruption in trade. That graph or that map on the top right is showing where ships are being rerouted around Africa due to the risks and the danger in the Red Sea, where the Houthis have been launching rockets at commercial vessels in protest of the Israel-Hamas conflict. So, there's a lot of risks out there, and you can imagine what that did to delivery times, what that did to the expense of shipping. I'm sure it went through the roof at that point for some of those routes. And of course, COVID on the bottom right was the most obvious one where we saw massive supply chain disruption. So all these risks are what companies are looking at, saying, "Hey, we need to bring our critical pieces back home, and that way we can rely on them much more. Um, just have that steady stream." And I'll go back for 1 second and just mention something. We're always going to have global supply chains, right? And what companies are doing, they're starting to figure out, I have two options, right? I used to have just-in-time inventory, which meant, hey, my supply chains deliver right as I need it. And, it's in every business textbook for the last 40 years, right? Toyota perfected it and everyone learned from them. And now they're saying, look, we need just-in-case inventories, kind of what they call that, which basically means we need to hold additional inventory of critical pieces that we cannot continue to manufacture without. The most obvious example was semiconductor chips. Ford was a case study there. They had a whole fleet of brand new trucks that they had manufactured that were not drivable. They needed chips, and so they're sitting in a parking lot. So these companies are looking at those pieces, saying we need these to be reliable supply chains. But if it's something that's not as critical, like plastic resins, for instance, you're going to look at that a little differently, right? Hey, if I have a Chinese plastic resin supplier and for whatever reason they can't supply us, now I can go and switch to a new supplier very quickly, right? From Brazil or Europe or who knows where. But I can have new product on my doorstep very quickly. But a semiconductor chip, obviously, highly engineered part, very bespoke to the application, and it's going to probably take months for that company. They don't have that kind of time when they have orders to fulfill, when they have a whole assembly line that may be waiting on that particular part. So huge risk, and there's been a monumental shift and change in the way these companies are operating and managing their supply chains. But a little bit of look, this is a little look at industrial real estate. This comes from the National Council of Real Estate Investment Fiduciaries. That's what NCREIF stands for. And just some projections on returns, right? And some past returns, 23 to 25. Obviously, office has suffered quite a bit, but you see multifamily and industrial doing very well and projected for, industrial kind of leading the pack there as far as projected returns. And then rental rate growth, right? You see multifamily and industrial. These are two of the darling asset classes that are always right in that top two. Depends on who you ask, who the best performing asset class is out there. But industrial is right there with multifamily, which is why I enjoy coming on to a meeting like this, Jonathan, because, there's so much exposure that investors have to multifamily. And it's a great asset class, right? And we all have a lot of familiarity with it. But I was making this point at a conference I spoke at recently, and I said, it's funny. I talk to investors, passive investors, for instance, and they might be in 8, 9, 10 different multifamily deals, right?
Right.
And they might be in one or zero industrial deals, right? So why is that when you have two asset classes that are performing both very well, right? And
Mhm.
so why is that? Why do we see that huge disparity? And frankly, it's because of familiarity, right? Most people understand multifamily, they get it, right? And industrial is a little more mysterious, right? You go on the other side of the train tracks, and there's these big box buildings, and there's a sign that says, XTZ Holdings or something like that, right? And I don't even know what's happening in there, right? And they might be manufacturing, chassis for school buses. I mean, it's usually something along that line that just kind of blow your mind. It might be, light assembly where they're putting together, some circuit boards that are going to go to a number of applications. And so it's pretty interesting, and I hope everyone's learning something just from what we're talking about here today. But get to dive down now into our strategy and what we do, really our niche and what sets us apart. When you kind of look at this entire industrial real estate segment, is sale leaseback acquisitions. Right. This is a transaction that about 90+% of our acquisitions are exactly this, where we're buying a piece of property from an owner user, we'll just call it Joe's Manufacturing, or, they're making the bus chassis like I talked about, and they own the property and they want to basically access equity that's tied up in the real estate and use that to grow the company, right? So this is a financing transaction for them. And in that transaction, we're buying the real estate, and at closing, we're signing, or I should say, the tenant, the seller, is now signing on a very long term, usually 20-year absolute triple net lease, right? So they're saying, look, we are going to trade rent for capital that's tied up in this real estate because we see a higher return on investment from this money growing the business than we do holding an asset like real estate. It's funny talking to real estate investors, people's immediate question is, why would they do that? Because we're real estate investors, that's how we think, right? We think that's a great asset. Who wouldn't want to own that? But again, this is choices. This is a prioritization of a business where, again, they see opportunity for growth and they're able to see, again, a much higher return on that capital by using that. And it could be used in a number of different ways. It's case by case. We see them sometimes just strengthening their balance sheet, right? Saying, hey, we're going to deleverage. We're going to pay down some short-term debt, retire that completely, pay down a little long-term debt, and put ourselves in a very comfortable position to continue to grow. Or it might be new equipment that's more efficient that would increase their productivity and output, thus increasing sales and EBITDA margins. That's their profit margin. So it's always case by case, and it's interesting for us to kind of learn what they're doing there. But there's a lot of different examples, and we see them all. But again, most of these companies that we're targeting that are selling and leasing back are privately held manufacturing companies, usually doing somewhere between 50 million in revenue to 500 million in revenue. So middle market manufacturing companies that are again making widgets, parts, what have you. So food production sometimes. So we source a lot of deals from our relationship with brokers being in this very specific niche. For a seller in the sale leaseback space, that execution is most important, right? For them, hey, I could go out to the highest bidder, but really what I need is someone to close reliably in the next 60 to 90 days. And everyone here, I'm assuming, has had some real estate transactions in their belt, and they've seen deals go sideways, fall apart, everything. And what they need is someone who can execute. And we really have that reputation of not coming up with excuses, and not coming in. And obviously, we still do our due diligence. And you find a skunk in the woodpile sometimes, and you say, "Hey, we got to retrade this thing to make it work," or just completely walk away. It happens many times. But we look at a ton of deals, and that's really what this graph on the left shows. Is really how much our acquisitions team looks at, and then how many deals we're offering on, and then diving into credit, and then going through management meetings and then being really selective. Hey, there might be some good deals, but is it a great deal? So really thinning out that group of deals and making sure the stuff that we're buying and closing is fantastic, that really stands up, has a very above market risk adjusted return. But
Mhm.
another way we're sourcing deals really unique is, oftentimes we're doing sale leasebacks following behind private equity groups as they're buying these manufacturing companies, right? So they'll buy the company with the real estate, and sometimes shortly after, or sometimes years later, they'll say, "Look, we're ready to do a sale leaseback, right? We want to unlock that capital. We don't want to tie it up in the real estate, and we want to do what we do best as a private equity group and grow this company, right? That's their investment." So that's been a great source of deals as you execute and close with these groups. They go, "Look, keep your phone on. We got another acquisition coming in a couple months. We'd like to spin off the real estate, and you did what you said you would, and our legal teams got along, and you have a good experience." And they certainly want to do that again with a kind of a repeat partner. So there's probably 6 or 7 at this point, private equity groups that we've done multiple real estate deals as they're buying these companies.
Mm.
So how do we mitigate that risk, right? And this is the most interesting, unique thing about what we're doing in long-term net lease, single tenant real estate is we don't have this operational risk that you see in multifamily or multi-tenanted, like in I'll call it retail, outdoor retail shopping centers. We have a single tenant, right? And we have an absolute net lease where the tenant's responsible for everything, right? So that includes fence line to fence line, as we say, but roof and structure, HVAC, who's paving the parking lot, who's handling the landscape. All of that falls on the shoulders of the tenant. So it's a really nice, it's very clean underwriting, and it's a nice position to be in. Of course, every investor envies the triple net properties. But where is the risk then? Because I don't have any operational risk from a day-to-day standpoint, but my risk is in this having this single tenant, right? There's a binary rent that's coming in. And so if this tenant goes out of business, cannot pay their rents, I went from 100, if we have to evict them, we go from 100% occupancy to zero, right? So we have a huge amount of predictability, but we have this concentrated tenant risk. And that's where we focus really heavily and where we've made a name for ourselves is in looking at the tenant credit really closely. It's more than just spreading the financials, but talking to the management team, looking at the competitive landscape, look at the industry that they're in, right? Where's that going? Years ago, believe it or not, I saw a deal where the company was a Yellow Pages manufacturer. I almost fell out of my chair. I couldn't even believe there were even Yellow Pages phone book manufacturers out there. I thought, are you kidding me? Where are these things, right? And so obviously that's an extreme example of an industry that, hey, you don't want a tenant tied to that, right? It's not a matter of if, but when they go down, right? But we will also want to look at the unit profitability. So some of these companies, they may have half a dozen more operating sites. And so if we're buying one of those, we really want to know that this is the crown jewel in that portfolio of assets that they have, right? I want the headquarters. I want the heaviest profitable profit center, right? And so the reason for that is as a company, if they were to get into trouble, if they were to over leverage, potentially they could file Chapter 11 bankruptcy, which is where you reorganize but continue to operate as a company. You want to know that, hey, they won't reject this lease because they can reject a lease in bankruptcy court, but they have to move out, right? And so you want to be holding a crown jewel, a property where they don't have a company without, or they could not continue to operate without this facility where, it might be their chief R&D center that has the headquarters office at the front where the C-suite and accounting and sales team all is. That's not a site that they're going to get rid of. A site that they're going to get rid of might be that overflow warehouse down the street, right? Hey, we keep additional product there. We keep some extra raw materials there, what have you, some extra equipment. That's going to be the first thing. If they get in trouble, they're going to get out of that lease as fast as they can if they can't afford it. And then, on the right here, what you see is defensible real estate. Look, I kind of equate what we do to a bond, right? And one of the principals at our firm said at one time, he goes, "It's like a bond, but we have better collateral, right? And that collateral is the real estate." So, in a worst case scenario, and by the way, now at 110 plus pieces of property, actual individual properties we've had with single tenants in them, we've only had one ever default on their lease, and we were able to sell that property as is, essentially vacant, and we're still able to get a profit on the sale there because we had such a defensible basis on the real estate. So really important there, right? Because that's a very final layer of defense there behind you is, hey, I could lose this tenant altogether, but I still own real estate, right? What's that worth today? What's it worth vacant? And so we want to buy as close to what they call dark value as possible. So target debt assumptions, just in case you were wondering, we always use fixed rate debt because we have all these fixed inputs. We have no exposure to expenses. We have a long-term lease with annual rent bumps. We don't want to screw that up with floating rate debt, right? We want to fix and remove the variables here so that we have this predictable yield. So typically 5 to 10 years in loan term, 60, 70% leverage, and usually 25, 30-year amortization. We'll sprinkle in some interest only debt here or there, but frankly, we like to have that amortized debt where you're paying that down and creating value over time, just like you would in a single family home, for instance. Um, and really, we sign a lot of recourse on debt. I think that's something that's unique about us. And frankly, we just don't have access to Freddie and Fannie loans, right? That's a residential loan product, which allows you to have, carve out recourse. So the principles here, we're signing personal recourse on all the debt, which is kind of a nice alignment and skin in the game for us and our LPs as we partner on these deals. And we work with a number of regional banks, community banks, even credit unions. Oftentimes they have some solid rates there. But here's a couple examples. Some assets we're acquiring. Actually, this one's around the corner. Probably the next 30 days we'll close on this particular asset. It's a sale leaseback. It's a brand new 18-year triple net lease. We'll be signing at closing with 2.5% rent escalations. And remember, with no expenses, your rent is your NOI, right? So we see NOI going up every single year as these rent bumps kick in. And so we're buying this. It's been, yeah, I have the new retraded amounts in here, but at an 8.5% cap rate. So really solid. We want to have a fixed interest rate on our loan to be about 2 points below that, right? So about 6.5% fixed rate financing, that gives us a 2% spread there. That's a nice healthy margin where LPs are getting, 7.5, 8% cash on cash from day one. So that's this is a very typical deal for us. And the company, just like the name suggests, they package produce, right? It's as boring as that. They have this cold storage facility here, as you can see, which actually was not originally cold storage. So it was totally outfitted and insulation and HVAC systems all installed to make this a cold storage facility. It's pretty cool. They have quite a few different zones because they have different types of produce that require different temperatures. So a lot of controls there. So a nice facility right in the Cleveland market there. Another one here, sale leaseback, 20 years. I won't bore you with all the details again, but annual rent bumps. This is a company that provides uniform and linen services for the New York City Metro, specifically Manhattan and all the hospitality that's there. They got started by renting out chef uniforms, right? The white chef uniform that any chef has. And, now they do all kinds of uniforms and linens. Obviously, there's some laundering aspect there as well. So they have this industrial facility about 35 minutes north of Manhattan there. So great location for the real estate and great industry that they're serving and good financials, right? They're doing close to 60 million or so with solid margins. They have no debt on their books whatsoever, which is a really nice thing to see. And then last one, really quickly, Robin Sports is a company that manufactures professional sports flooring. So gymnasium flooring. They actually have an exclusive contract with the NBA as well as their D League and G League. I think they might have something with the WNBA as well, but they do a lot of universities. They've been around for 100+ years, which is amazing. And I don't know what their secret sauce exactly is, but they've proven that there are less athletic injuries on their flooring than others. So there's just the right amount of give, I guess, to sort of be a little easier on the knees and all the joints that these athletes are so hard on. But this is a great acquisition. It's actually a 6 property portfolio with a number of different manufacturing sites as well as their headquarters that we're buying across the Midwest. It's across 3 states, Ohio, Michigan, and Wisconsin. So we have a single tenant there. And, in those cases, I'll mention in those leases, they're cross defaulting, right? So a tenant cannot default on a lease without defaulting on all of them. So that gives us a lot of teeth in case, one of them, you don't want a company or tenant getting any ideas like, hey, we'll just sort of stop paying rent on this one because we don't want to be there anymore, right? There's a lot of teeth in that lease that prevents them from doing that. And last slide, and then I would love to open it up for questions here. But These acquisitions, we roll a lot of them, most of them up into our industrial funds. And so a few years back, we started structuring funds, which is a great way to diversify that single tenant risk, right? So while that's the sole risk, we're able to diversify that across, 20 to 30 to 40 assets. And so if we ever have trouble with one of them, that's okay, right? We have a lot of assets in our fund that can support debt service. And so there's a very the preservation of capital is in mind here, right? So we're targeting a 6-year hold, and shameless plug here, Jonathan, but have to kind of show people what it looks like, right? So we're raising 250 million in equity here. It's about a 2x multiple on capital, and that cash flow is about 6 to 8% is where we're targeting during that whole period. We're fully anticipating that being north of a 7% cash on cash to investors. And that goes up over time, right? These rent bumps come up and we continue to increase cash on cash to investors. And total returns, including sale, is about 15% IRR. So I'll stop right there and just open it up here. I know there was questions kind of pouring into the chat. Do you want me to read them, or Jonathan, do you want to kind of answer
We
these
can have
questions?
Michelle unmute and just talk. Michelle, you want to unmute and just ask him the question?
Sure. Yeah. Thanks for speaking with us, Drew. Good to pick your smart brain on this. So I have several questions put in the chat. The first one is, what is the typical equity multiple you're seeing from your deals, and like whether those are typical? I think I'm asking this question because I have reviewed one underwriting for triple net leases of a warehouse deal, and like the equity multiple was like close to 3.
Sure. Yeah, I mean, it all depends on the strategy, right? And there's a lot of different higher risk, higher return strategies within industrial. I've seen some folks that buy vacant warehouses and they lease them up, right? So a big risk there in the lease up risk. But there's obviously a lot of potential upside there. So for us, we're buying stabilized industrial real estate. So equity multiples are tough for me sometimes. It's about a 2x across 5, 6 years. It drives me crazy because someone can spit out a 3, 4x. Look at a venture capital fund and they'll say, hey, we have a 6x multiple we're targeting, but it's, 12 to 15 years. And you go, well, okay, right. What's the IRR come out to? So, historically, what I mentioned on one of the first slides was our full cycle deals, which we've had 34 of now. We just went full cycle on one of our operating companies, but our full cycle IRR is about 18.1%. So we're targeting in the mid-teens, and we've historically averaged higher than that. But yeah, across 6 years, we're talking about a 2x.
Got it. Another question I have is that I know there are deals out there that can achieve a close to 30% IRR or at least 25% IRR like that. And no matter it is industrial or multifamily apartments, that is mainly because they are getting a very nice tax break from government. So like wondering what your experience is like and whether like those deals come across your desk very often.
The multifamily deals, I see them all the time from other operators, but no, deals that we have where I think you're saying, hey, is there some opportunistic deals that you're seeing with higher potential returns? And the answer is absolutely, right? So I talked about our fund here, but we also do opportunistic deals on a one-off basis. We'll syndicate them individually. And I mean, we bought an office building earlier this year. That's a little different. It was single tenant net leased. So it had some through lines with our strategy. We're working on a opportunistic deal in Aspen, Colorado on a luxury home. At the end of the day, we're real estate professionals and we're structuring a note there for our investors. But if it were equity, certainly some higher upside there. But yeah, as far as our track record goes, I mean, we've had a couple knock it out of the park kind of deals where, hey, we were in the 45% IRR range on a 2-year hold where, hey, we were able to enhance the credit, not directly, but there was some enhancement of the credit of the tenant, and the cap rates shift pretty dramatically if the credit improves quite a bit, which is what we saw happen there. So yeah, there's a lot of opportunity for upside from that, as well as development of additional space for the tenant, right? But I always caution investors, hey, if you're looking at deals that project 30% IRRs, be wary, right? These are projections and there's a risk that comes with that. And maybe it's a reasonable projection of return, but it's going to come most likely with a higher level of risk. And if it's not coming with a higher level of risk, then good for you, invest with them, right? But chances are you're looking at some risk somewhere. It is an inefficient market, real estate. However, there are a lot of buyers out there too. So it's interesting. I mean, I see these deals hit my email inbox all the time, right? Projecting 24, 30, 35% IRRs. And I don't have the time to look at them all, but I would always suggest that people look at that, understand the risks that they're taking when they look at it. But yeah, I mean, if you have a real estate deal that's offering some kind of tax break, that's specific to that property, whether it's opportunity zones or something else, certainly take a look at it. And opportunity zones come with their grains of salt, right? 10-year holds, some neighborhoods that may be struggling. There's some different factors that you have to take into account there. So yeah, I don't mean to generalize too much here, but if you're asking if we do some deals that are certainly have a higher element of risk, absolutely. We were working on a deal recently, and I think it's not going to happen at this point, but it's a sale leaseback with an aerospace space exploration company, a company that builds rockets like SpaceX for the government. They're called Firefly Aerospace, and that would be a massive return. I don't no guarantees on if that deal comes together, but here you have a company that's not EBITDA positive. They're a late stage growth company. So it's not a typical deal for us, but amazing opportunity where they're projected to be EBITDA positive next year. And you look at buying at an 11% cap rate, right? And so you see the draw there. Hey, they have a lot of backing here. They have 525 million in backlogged work that's sitting on their plate and contracts with NASA, the US government, Department of Defense, and contracts to send a couple of lunar landers up to the moon. So you start to see a lot of that and you go, look, there's more risk here, right?
Yeah.
And a lot of that comes from the industry that they're in, right? Hey, what if a rocket, I don't know, blows up, right? They're not launching them from this particular property, but they're testing them and they're building them there. And there's some environmental risk, right? There's jet fuel, or sorry, not jet fuel, rocket fuel that they're using to test things. So there's a lot of factors there, but something like that, you look forward and you go, these guys are likely going to get bought out by Lockheed, right? Or Boeing or whoever, right? And if and when that happens, the credit is a massive change to a cap rate on a property with a long-term net lease. So let's just say Northrop Grumman, who this company has a partnership with, says, hey, we want to buy the company. Now you have a company that's doing however many billion in revenue backing that lease versus a late stage startup. And so now your property's not trading at an 11%, it's trading at like a 5.5, 6% cap rate today, right? So that's one of those plays where there's a lot more upside. So yeah, I mean there's all kinds of strategies within net lease that you could find opportunity for more upside. For us, we really like this stabilized real estate segment. We go, look, there's predictable cash flow. And when I first met the guys at MAG, I mentioned I had a long relationship. I started putting money into their deals personally because I said, look, I want something that cash flows predictably, like a debt fund, but I don't want a debt fund, right? A debt fund is not going to give me any appreciation or upside in 3, 4, or 5 years. And frankly, I'm just too far away from retirement for that, right? I want to participate in equity upside. So that would made logical sense for me as a guy who valued cash flow, but also wanted an equity play with a lower element of risk. And mid to high teens IRRs is certainly well over market. But yeah, it pales in comparison to a redevelopment deal that's like, hey, we can hit 25% IRRs here.
Yep, makes
Hopefully
total sense.
hopefully I didn't ramble too much there, but
Oh no, like it's very rich in information. I appreciate that.
sure.
Good. Good.
Um,
Anything else, Michelle? Any other question you have?
a final small one like that I also put in the chat. When will be some situations that you will have you'll be eligible for SBA loans?
None. These are investment real estate. Actually, there is some situations, but it's not on the real estate side. I mentioned we have a private equity side. So as we're buying and managing operating companies, that's a target for an SBA loan. But on the real estate side, investment real estate doesn't qualify. It has to be owner used. So we have used some SBA products for debt as we acquire operating companies. And there's some good terms you can get from SBA loans.
Yeah, thank you.
Great. Okay, anyone else want a question? One last question for Drew? Okay, I think we're good. Thank you, Drew. Thank you for appreciate your time coming and thank you for your insights.
Sure. I don't know if you have a follow-up segment here I should sign off, or if you guys wrap up the meeting after. You tell me, Jonathan.
It's up to you. You can leave if you like. You want to stay up here. Like we're just gonna go around the room, introduce yourself and talk about topics in my mastermind, basically.
Sure. Yeah. You know what? I will just stop sharing here and leave my contact information in the chat, and I'll let you guys have a conversation. But thank you guys so much for having me. I appreciate it. And if you have any follow-up questions or want to explore opportunities or just, be looped in on future opportunities that we release, there's a number of different opportunities. I just kind of showed you our core investment strategy. Please reach out. Take care, guys. Appreciate it.